Hello and welcome. My name is Gabriela Cruz, and I serve on the board of directors of the Global Digital Asset and Cryptocurrency Association, or Global DCA for short. Based here in the United States, we are a globally oriented self-regulatory association, focusing on three key areas: advocating for balanced regulation for the digital asset industry, raising awareness and enhancing education in the space, and setting principles-based standards to help steward our shared digital future. Our diverse and inclusive membership model touches all aspects of the digital asset ecosystem and welcomes individual entrepreneurs, small and medium enterprises, as well as large multinational corporations, all committed to our code of conduct and leading responsible innovation around the world. Together with our esteemed conference sponsors, the Global DCA is proud to partner with Tabb Forum to present the DeFi-ing Expectations 2021 conference. With its roots in blockchain technology and peer-to-peer financial transactions, the world of decentralized finance, or DeFi, is attracting more than just niche investors. Increasingly, institutions are exploring how and in what way they may enhance efficiency, execute transactions more effectively, increase returns on assets, and maximize profits using DeFi. With the proper understanding, risk management, and support, businesses may be able to defy expectations and enhance their operations. Today's conference draws together the industry's most distinguished thought leaders and executives to offer insight on emerging trends, products, and applications tailored to the unique needs of the serious institutional investor. As we have a full schedule today, I would like to take a moment to thank our members, conference sponsors, and all of our amazing panelists. And I will pass it over to my friend and colleague, Bruce Morris, CEO of Tabb Group. Bruce?
Thanks, Gabby. And from everyone at Tabb Forum and the Global DCA, welcome to DeFi-ing Expectations 2021, utilizing decentralized finance to drive institutional performance. Today's event and simultaneous receptions later this evening are designed to offer insight on emerging trends, products, and applications, all tailored to the unique needs of the institutional investor. If you care about who else is on the other side of the monitor, DeFi-ing Expectations has attracted a global audience of over 1,000 institutional digital asset professionals representing over 400 companies, all focused on one goal: how to make the digital asset markets drive investment and operations performance while simultaneously providing a safe and compliant marketplace for all to participate. Special thanks to all of our speakers and sponsors. We could not have done this without your participation and support. I hope everyone finds spending time at the event today of value. We realize there's a lot of competition out there for your attention. So let's get started. Today's kickoff discussion offers a great overview of the DeFi and digital asset markets. I am very fortunate to introduce our opening conversations participants, Sam Bankman-Fried, CEO of FTX, along with Jon Kol, Galaxy Digital's head of principal investments, and Nazia Siddiqi, head of Counterparty credit risk, also from Galaxy Digital. Jon, the stage is yours.
All right. Thank you, Gabby and Bruce, for letting us into here. So today we have myself, we have Nazia, my colleague here at Galaxy, and we have Sam, the co-founder and the CEO of FTX. So we want to make this feel a little bit more like a conversation. We thought that a great way to start off, given the nature of this event, is to talk about how our personal journeys here kind of chart the course of crypto evolving from what you'd maybe call more of a hobbyist thing that people dabbled with until becoming a much more institutional marketplace. And for this conversation, we have probably the best person to talk about it, none other than Sam. Sam, could you tell us a little bit about what it's been like for you from, the moment you left Jane Street and got involved in the crypto to today running the powerhouse of a firm that you run in FTX?
Yeah, so I left I was a quant trader at Jane Street trading international ETFs and left in late 2017. And maybe I'll first talk about what's the same between now and late 2017. although very different than most of the time in between, which is the amount of excitement about crypto in the world. It's hard to remember all the way back in 2017, at least for me, maybe other people remember that far, but it's been a few decades for me since then. So, like today, I mean, just like you turn on CNBC and you're like, yeah, 50% chance they're talking about crypto, which is a lot of percents. Crypto is, I mean, today it's up a lot, and it's what, like less than 1% of global market cap of stuff, and it's 50% of CNBC. And it's, I mean, I don't know if your two uncles are talking about something financial at the dinner table for Thanksgiving, it's probably crypto. That's like a pretty good guess, you know? So like back then, there's unbelievable amounts of excitement and interest, just off the charts, in crypto. In between now and then, no one gave a shit. I mean, I'm exaggerating, obviously, but like the doldrums of 2018, 2019, right? Like late 2018 and most of 2019, really, like I would say down by a factor of like 10 in terms of the amount of coverage that crypto was getting. So what are the differences between now and back in late 2017? Late 2017 bore a lot of resemblance, I think, to like spring 2020, in that you started to hear murmurings of like people were getting more excited about crypto, and you started to hear institutional murmurings. You know, you had one or two jumping in, and like if you talk to a lot of investment banks, they'd be like, yeah, you know, we're having committee meetings again on crypto. We're seeing if we're gonna do something. We'll see. I don't know, you know? And it's been, you know, a year and a half, I guess, since then. And in that last year and a half, something has happened that did not happen last time, which is all the institutions decided, yes, they are going to get involved. And why didn't it happen last time? I think it's timing. I think they're kind of on the path to that in like January 2018. Then February came, things crashed. They crashed before the panels voted yes. And so the panels voted no, you know? And so we didn't end up getting that institutional interest until the, you know, giant bull run of 2020 and 2021. But this has been sustained for a year and a half instead of 3 months. And that's been long enough for every financial institution I've talked to in the last 6 months to have decided, I've talked to all the major ones basically, to have decided affirmatively that they are going to do something in crypto, not today, who knows what, not them, but it'll be something. And that's just an enormous difference. Like every bank is excited to talk to us. Now, to be clear, they're not like, yes, we will bank you for customer deposits. They're not that excited to talk to us, right? They're excited to talk about talking to us about those things, though, you know? And you can feel everyone has a very strong sense of which way things are going. And we see, frankly, very little disagreement on that. Like very, very few financial institutions that we talk to think crypto is going to go away or be a fad now. Almost everyone sort of phrases it as like, yeah, this is whatever, we know we have to get there.
Yeah, absolutely, Sam. I would agree with that. I joined Galaxy December of last year to head up credit risk. And just in the past, now it's been 11 months, just such a huge difference in the amount of counterparties that are onboarding, their nature, like how institutional they are. There's constant interest. And I think that's the thing. I think now it's not just this topic to talk about. It's people are here to stay and they know that crypto is here to stay. It's not going, it's been dramatically different just in these past 10 months. So comparing to 3 years ago, yeah, it must be very, very different.
Yeah, I mean, Sam's point about the excitement was there. People were looking around back then. But now what is certainly palpable is that at minimum, everyone wants to talking about getting into crypto. And so I think obviously Sam's seen it, you've seen it, we've seen it. You see it across every facet of the industry where there's just a rush to find a way to get involved. And whereas back then you may have had, you know, a single champion at some organizations, there are multiple champions at every organization. And that's the thing that got this over the line. And of course, certainly helped that this has been a sustained, call it 18-month period of excitement versus, again, back then we had kind of a quarter, maybe 6 months of things going well, leading into a subsequent crash kind of starting January 8th of 2018, a dark period for all of us who were involved at the time. But it definitely feels like there's been a maturation, right? And this maturation, with it, what it's brought is, as these institutions transition from just like, okay, interest, to now holding the committees, to now generally they're talking openly about their next steps and speaking to companies in the space and finding ways to get involved, to maybe slightly more mundane talking about, and now they're presenting with the companies that they're speaking with. Now they're going through the process of, how do we get involved? What can we do? Does this meet our standards? And both of you are in places, and certainly myself as a venture investor here, we really run into and see where there are sometimes good matches and sometimes there's still kind of a chasm to cross. Sarah, can you tell us a little bit about, in your experience, what are they asking for that actually is reasonable, and now those are standards that are going to be met? But sometimes I'm sure you must see cases where they're asking for things where probably just don't fit this world anymore. They might be asking for things that are actually, in this case, totally moot, and we could talk about that too.
Yeah. So let's start with the reasonable things. They do due diligence on us like they do diligence on any of the companies to start with. So whatever, KYC, the ultimate beneficial owners, blah blah blah. Then what do? They do a deep dive on our compliance policy, and by compliance, I particularly mean AML KYC policy. And they do a much deeper dive than they do on any other company. And, we get a lot more scrutiny than a payment processor does, which isn't obviously correct to me. Like, payment processors are also involved in a lot of money transmitting. And in fact, the thing that we do the most of that money transmitters don't do is not particularly relevant for money transmitting. It's the trading. But there's an extremely high standard that sort of crypto companies are held to on diligence around the KYC portion. And when I say high, it's worth noting, no one knows exactly what they're looking for here. Like, no one's like, oh, they don't have this piece of their policy, because no one knows what pieces it's supposed to have. It's sort of a holistic thing, and everyone's feeling it out. So that's like a big thing if ever I'm going through that policy. People ask a lot about our licensure, right? And we've put a very large effort into that last year. We're now licensed in 7 or so different countries. We have a number of US licenses, and we have a number more likely coming before the end of the year. Okay, so that's sort of like a step 2, maybe. And some of these can veer into the unreasonable, but many of them are pretty reasonable. Like, many of these are like a reasonable enhanced diligence to do on sort of an emerging sector. Occasionally we get just crazy requests, right? Occasionally it's just like, please, like, give us a set of documents that could be used to go public and get a bank charter at the same time in order for us to like subscribe to your API feed, not use it, just like get the market data. And be like, what the fuck do you care about our custody? You're just reading market data. Okay, so there's sort of that, but that's not the norm. Really the norm, and like the reason that this takes forever to do a lot of these onboardings is 2 things. One of them is custody. No one knows what the answer is on custody. No one knows what the right answer is, because fundamentally crypto does something different than traditional finance does by default. And I don't know what you do about that. In traditional finance, you put all your money with one prime broker, and then they connect to each exchange on your behalf. Crypto is disintermediated. You go straight to the exchange, but there's no place you can put your money such that it's accessible on 2 exchanges at once. So it's a complete reverse. And people are like, well, what if we just put it at a custodian? It's like, yeah, you could put it at a custodian, but that doesn't, what's the custodian going to do? It's the custodian they can to exchange separately and like put your money there. You feel that much better because you sent it in a blockchain hop on the way there. Like, it's sort of like, it's introducing another stuff, and maybe it helps, but I think you have to think about why. And so, okay, so that's one of the big pain points, just understanding what even is the right custody framework for an institution here. The other, and probably the biggest sticking point, is vague compliance concerns. And these aren't identifiable compliance concerns. Those are, you can identify them and then you can address them. These are like, we have to get our compliance department comfortable with the flow, is the kind of phrase you'll hear. And that's language for like, it'll be 1.5 years, right? And like, there's nothing you can do about it. right? Like they need to get comfortable with it. And we're like, great, what can we do to help? Like, we'll tell you if we find something you can do to help. But they don't really have anything. It basically goes to their compliance. We're like, oh, Jesus, really? You want to do this? And like, yeah, they're like, we're going to get such a big fine. Come on, don't do this. I feel like, no, this is really important for business. I was like, you really want us to figure out how to deal with crypto? And the business seems like, yes, absolutely. And they're like, all right, well, I guess we'll talk about it. We'll discuss internally and maybe sync up again, you know, in a month or so. And then they say, come around going like, all right, so you guys can do it. And it's like, well, we talked about it and we definitely are concerned.
We want to.
We don't. We want to. We need to make sure that we do it the right way.
Yeah, the right way. We get that all the time. I laugh because I've been on both sides of these conversations 1,000 times in the past 4 years.
And of course, in some cases, this is totally reasonable because in some cases they're like, look, I'm sketched out by this. Like this company doesn't seem right to me. And I get that, but I think in other cases, they're like, actually, there's nothing that seems that wrong to me. It's just like, this is a scary word and there's a lot I don't know. And like I'm kind of like, I have a duty to protect my company and I'm like worried about this. It's new. What if I screw it up, you know? And it's also kind of, I understand it. But it means that these progress real slowly.
Yeah, I think what's so interesting about this space, right? I'm still relatively new. I was in traditional finance for around 15 years before coming. But what I find so interesting that I think scares a lot of institutions is the amount of leverage offered in crypto. And so leverage in general in finance is considered this really scary thing that you should be very sophisticated to use and et cetera. Crypto, because of that exact decentralization, really allows anyone to use as much leverage as they want when you go into some of these crypto exchanges. And then also in the DeFi world, there's a limit and they've come down. But I think for traditional world people and for the institutional world, that concept of a lot of leverage offered to everybody is a little scary. And I think as I've gotten so much more comfortable in this space is the traditional world is very used to these very long margin periods of risk. Like let's say your counterparty defaults, now you have to wait a certain amount of time to close them out and liquidate the position. The thing that is amazing about crypto is it trades 24/7. So there's no concept of like, oh, there's an issue on Friday night, now we're going to wait till Monday. It's immediate. And what these exchanges do, which is a huge, huge thing on the risk management side, is that if you're falling below a certain level because the markets are moving against you, you can be liquidated immediately. And so that concept is something that I think for more and more institutional players to feel comfortable in this space, they're going to have to grasp and really understand how those models have been derived, right? Because it's not like you're waiting for a person because you have to deliver a notice and that takes a while. It's like the quickness of crypto is this huge thing that makes it scary for institutions because markets can move so quickly, but it's also this huge risk mitigant, which I think is just super interesting.
Yeah, I mean,
it takes a minute to understand.
It absolutely does. And I think a lot of people go through that process, like real-time liquidations. That's scary. That's so much scarier. And we're like, no, it's the opposite. This means that you don't have to sit there unable to liquidate, watching a position go underwater. This is good for the risk model, right? Yeah. And I think to address another thing you said, the disintermediated nature of crypto is interesting. It means that there's easy access to a large variety of users that's like a big pain in other things. That being said, there's one thing I want to sort of like push back on a little bit, which is this notion that like futures and margin are unique to crypto. People talk about how like there's more volume in leveraged futures in crypto than in spot. That is true of every financial asset class there is. You can't find one that has less volume in futures than spot. In fact, crypto's ratio is I think a little bit less than many asset classes are between futures and spot. Like this is not a crypto specific thing. This is just true everywhere. It makes sense. Futures are the economically efficient thing to trade if neither party cares about delivery. And so that's where most of the volume goes up. And, you know, sophisticated traders are always accessing leverage and retail traders sometimes are. And this is actually true across asset classes as well. Crypto isn't that unique in these regards. And I don't want to say there's like no differences here, but I think that the differences have been a little bit overstated. And obviously crypto is more volatile, right? And so like, you know, there are some real differences here, but I think that like people will sort of frame this as some weird, scary crypto specific phenomenon, and this is just how finance is everywhere. And We saw it, I mean, at Jane Street, I saw similar things going on everywhere, right? People looking for trades that they thought had high upside. And high upside usually means high downside as well. And that's where a lot of the flow was, a lot of the volume was. The thing you don't have in crypto that you do have in traditional finance is a massive, massive size institutional flows into standard products. And so on top of all of the sort of like more bespoke trading, in traditional finance, you just have like the pension funds being like, this month we are putting $500 billion into German stocks. That's what we're doing. And it's just like buying an enormous amount of German stocks, just like all of them index weighted, you know, and be like, oh boy, that's a lot of buying. And it's it'd be like pretty bland standard products, but like massive, massive, massive institutional inflows or outflows coming from them. And that is not really here in the same way in crypto yet.
Yeah, and I think the difference also is with that traditional world is there's this concept of leverage or credit is extended based on credit worthiness, right? So it's not that the customer just chooses, okay, this is how much leverage I want to use. And so I think that's probably a slight, that whether it's right or wrong, but that's what institutions probably feel a little bit more comfortable with, that there's some assessment being done before leverage or credit is offered.
Yeah, of course, there's this flip side of it, right? Which is that you do this on a traditional asset and you lose money, and then they come billing you, saying you got to wire more money in, or we're going to sue you. And in crypto, the whatever you put on the platform, generally that's all you can ever lose. They won't come after you. And so if you only put $1,000 in, they can't go after money in your bank account, which is a nice risk mitigation technique.
Absolutely.
And although we could actually end up seeing, you know, more credit being extended away, you know, with the collateral being off the platform, I'm sure, I don't know if you guys have experimented with it, but I imagine as we kind of see the industry maturing more, growth from other areas stagnate a little bit, I'm sure there'll be some exchanges out there, and maybe not even exchanges, maybe other platforms who are looking to extend credit because why not, right? If someone thinks they can make a business out of it, I'm sure someone will try.
It's all over the place in crypto already.
Yeah. Now, if I would say one of the areas I was trying to lead you into with that question earlier was the point about custody seems to be, at least from my experience, where we run into the most confusion when it comes to crypto, because there's this fundamental, like, again, traditionally you're used to, oh, well, we have a custodian, the assets are with the custodian, they're never with the where I do my execution. Those things are very well separated. And there's this forgetting that we actually, you know, in a way, blockchains are kind of like their settlement and custody machines. What they do, it's kind of built into it. That process has, at least in our experience, there's been a lot of education involved with it. And even still, sometimes people 6 months, 8 months after their first foray into crypto still clearly appear to be a little bit unsure about it. What's it been like for you guys dealing with, you know, really big players for getting into crypto? Do they get stuck on custody? Is that kind of a sticking point at all?
Absolutely. Like they absolutely do. And it's an interesting topic because, you know, like, look, we need to use a custodian. I'm like, tell me more. And like, you know, it has to be a custodian. We're like, all right, what do you mean a custodian? They're like, you know, party to custody the funds. And I'm like, yeah, that you can conjugate it. I agree. But like, describe such a party. And they're like, well, they're good at custodying funds and have connectivity to order books. I'm like, do you mean like a wallet on an exchange? Like, no, like a custodian.
Yeah, custodian, like, it's a thing.
Custodian. I'm like, all right, what if that wallet on the exchange was tied to an entity that was a qualified custodian? Like, qualified custodian. Like, yeah, it's a trust license. Like, oh, it's a qualified custodian, huh? Like, yeah. They're like, I don't know. Is that what I meant? It's not really what I meant. Like, all right, well, what like, well, yeah, no, sort of like I don't know, like we have custodians, right, in the space. I'm like, you mean like qualified custodians? Like, well, no, I mean like, and so I think sort of like this interesting conversation where like teasing out exactly what people mean by it is super interesting. And I think no one actually knows. And all the custodians are going through this too, right? You have Anchorage, if I guess BitGo is with you guys now, right? And you have you know, Coinbase has their in-house custodian. So there's 3 different flavors of custodian. And like the real answer is, I think, like people like the idea of it being a custodian, but they haven't yet decided which part of it they like and what it would take to get them that part, and like how that applies to like, well, it's like, okay, is Galaxy a custodian now because they acquired BitGo? Like, yeah, it's
sort of, yeah.
Right. It's an interesting question, right? And so I think that like when you try and mechanically break it down to what are people looking for here, I think some people it's just a legal thing. Like they're like, look, I'm only legally allowed to store my funds with a custodian. And probably think a qualified custodian is probably about as close as you can get to what that means. Mm-hmm. For some people, I think they want it to be a different entity than the more magic engine and order book. It's gonna be, and I'm like, okay, what if there's a common owner? Like, no, probably not, and I think for some people, it's someone who's good at safeguarding shit. And then other people are like, well, it's gotta be an insured one. We're like, all right, let me walk you through the history of custody insurance and tell you exactly how much it's paid out ever for any of this shit, right? And like well, paid, but like it's still like, well, if we get FDIC insurance, I'm like, you're trying to put $10 million in. FDIC insurance would get you 100,000 optimistically covered. Like that's not going to help, right? Like that's not, you're not worried about losing the last 1% of your assets, right? That's not. So I think it's really interesting. I like don't know how it's going to end. I think that it's going to be a fractured mess. And then, institutions like big banks are going to be like, we can custody, and everyone's going to try and sign up with them, but it's going to be a horrible experience. They're going to stop. And they're like, oh God, I don't know what to do now. And so I think it's like legitimately don't know how this ends. And I think some people are just going straight to exchange. Some people are using third-party custodians. Some people are trying to use like, Fidelity or Boney Mellon. And it's just going to be messy, assets flying all over the place, lots of bespoke agreements, none of which line up with each other. And, 30 years from now, it'll gel a little bit more, maybe.
Yeah, I think, your point on specifically just, it's not clear that people know exactly what they're looking for is the most interesting one. It's because this concept of a custodian in traditional markets is so well ossified. You don't stop to investigate. What do they actually do? Why am I actually using them, right? Well, part of it is the law. Then second, there's, at least an 80-year history of like, this is kind of how it's done in Western capital markets. So I guess we're going to keep on doing it. And people, they know they need one. They don't know exactly why or exactly what for. And as we transition into this new area where, right, like the asset by itself is always custodied in some wallet, whoever owns the wallet is effectively the custodian. Then you have, okay, well, if the exchange has a license and, is a trust and is a qualified custodian, does that count? It'll take a little bit more time, I think. And maybe if we'll see, specific regulations that pertain only to crypto assets and not to broader securities, maybe then now if the laws update, maybe someone will be able to say, oh, okay, now I know. Maybe that leads me into, again, for both of you from your seats, how do you see new regulations coming? Have you thought about this idea of, do you have any opinion on should there be maybe a crypto-specific regulator? I'll tell you, I'm super biased. I certainly hope there will be a crypto-specific regulator versus trying to jam these rules into, the paper frameworks of the paper securities world. So what do you think, Sam?
So rather than talking about the regulator, I'll talk about the regulation. I think that you could absolutely do this within the existing regulators, right? Like you look at the SEC, which has lots of experience with markets and with issuances and with consumer protection. You look at the CFTC, which has lots of experience with markets and with clearinghouses and risk modeling and consumer protection. And like they cover a lot of the ground here, right? But putting that aside and looking at the actual regulation, there's a lot of things left to be improved. One example, what is the current regulation for spot cryptocurrency order books? Like which regulator oversees that? What are the rules around it? There basically is none. There's the money transmitter framework for deposits and withdrawals. There's the CFTC for futures. There's the SEC for securities. A spot Bitcoin USD order book is sort of homeless right now. So okay, that's got to be figured out. One big worry of ours is that we'll somehow end up with a system where a Bitcoin future and a security token or maybe security token spot market will be in completely different frameworks under completely different regulators with no ability to collateralize, to margin, to have a central clearing for them. and it'll be completely shitty user experience switching between them, right? So I'd really like to have a unified or unifiable framework, at least, in which lots of different crypto asset markets and custody and clearing and collateral could live in one universe. Maybe it's a joint universe by the two markets regulators. Maybe they sort of divvy it up or something, but come up with frameworks that plug into each other nicely. So I think that's sort of a big thing. Obviously, something's going to have to happen on how the world is currently treating tokens that might be securities. Like, lots of people are at loggerheads right now. And I really hope the state is better in 2 years than it is today. I think that's going to take everyone coming together. I think it's going to take like the SEC, token issuers, and the exchanges sitting down at a table and be like, all right, let's figure out what the framework should be here. Let's figure out, is this a registered exchange? If so, what registration is it? Let's figure out what needs to happen for the issuance of tokens. Let's and like hashing out something that has the properties which are necessary to give regulatory comfort. And that's something which I'm hoping will happen. It's probably going to be a medium to long-term task to get there. And then stablecoins, they come up a lot. I frankly think this is the easiest one of these to handle, because I think there's a straightforward regime that gets 75% of the way there with very little collateral damage, which is, you say if you're a stablecoin and you want to get US liquidity, you have to give daily attestations of exactly what is backing your stablecoin. It needs to be not junk bonds. It needs to be reasonable crap. And you maybe need to over collateralize. Like, maybe you're haircutting if it's not just dollars in bank account. Maybe you have a 0.5% haircut on treasuries, a 5% haircut on corporate paper. I don't know, I'm making that up, right? And then you have, semi-annual audit to confirm that your assets are exactly what they say they are. And like right there, that regime addresses the biggest worries in the stablecoin space, which is, what if you get $1 trillion stablecoin with $1 billion of assets backing it, right? Like, that is the huge elephant in the room, and just not that hard to have oversight of that. And it doesn't get in the way that much of things. It's just like, and so I just feel like that's the right place to start, is to get in place a framework that would be reasonable and that would address the biggest concerns. And there's always gonna be more details to hash out later. You probably would need to have a blacklist for financial crimes related addresses. Most major stablecoins already have this. You could have a centralized process for this. You could have like an API that Treasury produces and all regulated stablecoins must consume, which publishes a list of blacklisted addresses each day. I don't know. There's like
stuff that to some extent is already in place.
Exactly. This is sort of analysis and Serum Labs in places are already sort of doing this, right? And it's like, so it's just not that hard to put these pieces together to address the major concerns while still leaving stablecoins in place where they can revolutionize payments. And instead, I'm worried that we're just gonna have a lot of yelling about them back and forth, and a lot of bad proposals, and a lot of talking past each other, and a lot of worry. And I get the worry, but I just feel like we can address it, and we should do that.
Yeah, absolutely agree. I would touch on two of the things you specifically said. Transparency, it's key, and just in everything. When you're going into a new space, transparency is something that gets everybody comfortable. So transparency is such a key point. And two, my hope's really that we not try and fit a square peg in a circle hole, and understand that there's new things that need to be developed to understand things that will be specific to the crypto markets. Because we can't just assume like, okay, we're going to make this fit with everything we have. I do hopefully it's not the long term, maybe the medium term, people work together to understand what makes sense, where there is a need for regulation, but where there are things that just aren't necessarily applicable for crypto.
Yeah, I completely agree. And I think you can frankly do a lot of this roughly within current regulatory frameworks with just a few modifications or a few clarifications. And I think you're going to need to be creative in a few places, but I don't think this needs to be a wild new drafting of the Constitution type thing. I think there just needs to be like agreements between agencies and industry and Congress on some key points here. And the rest, like, anti-market manipulation stuff, like the markets regulators already know how to do that. It's not like, spoofing in crypto is some magical dance that is completely unrelated to spoofing in stocks. It's sort of the same sort of practices and policies.
Yeah, it's the same activity, just a different asset, right? You think that this would be not exactly a surmountable task.
Exactly. And so I think I'm optimistic that we'll get there. And I think, I empathize with the industry that wants more clarity from regulators. I also empathize with regulators that feel like industry has not been putting their best foot forward in this whole conversation. And, I'm hoping we can work together to hash out what needs to be hashed out. And, frankly, it's very unlikely we're going to get a comprehensive crypto regulatory bill passed through Congress anytime soon. 60 votes is a lot of votes to get through the Senate. But I don't think you need to do that. I think with proper regulatory guidance and color and endorsements from the right players, I think you can establish a pseudo, answers to a lot of these questions without needing a bill to be passed.
I appreciate your optimism. I hope you're right.
Yeah. I'm not saying it will happen. I'm optimistic that it would be eminently doable.
We have to. Also, I think we're kind of optimistic by nature, or else we probably wouldn't have been here and stayed the duration of some pretty negative times. It's interesting, specifically with stable coins, right? You'd think these are not that different from the numbers when I log into my Wells Fargo account. They kind of display this strange dollar balance. I don't know where it is. Hopefully they have it.
PayPal dollars, Venmo dollars,
yeah,
right? Those are sort of closed loop stable coins. Like there's sort of the spectrum from that too. And then on the other hand, you have money market funds. And, they're sort of like often treated as if they have no relationship to each other. It's not like really true that they have no relationship with each other. And, I think that like one thing I will say is no one is buying a stable coin with an expectation of profit. That one I think we can all agree on. No one is hoping it goes above one, really. But but yeah, I mean, this notion of a ledger entry for $1 permeates the world.
Totally. They really are just different forms of e-money. The IMF spent a lot of time the past 5-6 years defining what e-monies are, everything from what you described to, right? Like the balance at your bank account to your PayPal or Venmo dollars, the equivalent of like money in a WeChat account or an Alipay. And actually, funny enough, 2 years ago, they added stablecoins to those definitions. And so I think the IMF is onto something. It's so, but switching gears a little, so we don't have a lot of time left, but with the time remaining, why don't you guys tell us, and then I could share a little bit from my end, what's the thing you're most excited about with respect to, what's on your plate specifically and the industry more broadly?
I mean, I guess I'll say like regulation. That's a huge amount of what we're working on right now. And I think the thing I'm most excited about, both for us and for the industry, is progress on the U.S. regulatory front. And I'm optimistic. I'm optimistic about working with the CFTC on products for FTX US derivatives, which would be really, really amazing to be able to launch. I'm optimistic on frameworks for digital asset tokens of various varieties. It's going to take work. I'm optimistic we can get there. I'm optimistic for global regulation. It's going to take a lot of time, a lot of work. We're going to spend upwards of $1 billion this year on licensing and regulation. It's expensive. It's the right thing to do, I think. That's one thing. And then the other thing that I'll say, and I apologize for those who have heard me say it before, but I can't get over my frustration on this, so I can vent again. You should be able to have a mobile app that does what you want to do with your money, that lets you invest in stocks and in crypto and send money to a friend and buy a banana through a debit card and take direct deposits. And that's it. That's the list. Sorry, there's no more. And like, it's sort of weird that none kind of let you do that right now. I think crypto is probably going to be the first place to create one that does. And some other countries already have. They do quite well, and they make people's lives a lot better. So I would be really excited for the West to catch up to that.
It really does feel like the most American thing, right? Like something that lets you do whatever the hell you want with your money. And we don't have it yet.
And it's not that any of those things are illegal. It's that it's currently annoying. You have to click too many buttons in between and wait 3 days for an ACH to clear.
the most perplexing thing about the
Really is.
American payment system. You know, Venmo is magic until you try to take your money out. They're like, well, 3 days.
Yeah.
What happened? You know.
Yep.
What about you, Nazia?
Yeah, I would say absolutely just continuing to see the industry mature is really exciting. I'm telling you, over the past 10 months, what I've seen is amazing. Continued growth by both crypto natives just getting bigger and bigger and more institutions coming on board. I think it's a wonderful thing. I also just, as crypto continues to evolve, really access to markets for all. I think that's a really important thing. And I think access to financial markets is phenomenal, and doing it without intermediaries. So I think that space, I want to see it continue to evolve. I want to see access for more and more continue to happen. I think it's a really exciting thing that I'm going to, really closely watch over the next several years.
Absolutely. I think we're with you on that. I'll say from my end, this is a term that on our team we've sort of invented, but I'm very excited about this thing we've been calling the accountless internet that we think that crypto enables, right? If everyone here probably can think about how many accounts they have with just all the applications they use. Average user, they probably number in the hundreds. If you're like me, you probably have thousands of accounts. Everyone has so many accounts that there's a thriving industry of password managers. I'll be very happy if I never have to sign up for another account for the rest of my life. But part of the magic with crypto is that and I think we're going to change what we call them. We call them wallets now, but your wallet can act like this meta account. And, if you're using DeFi, let's say on Ethereum or Solana or really anywhere, you just have that wallet and you never have to sign up for any account. All the apps just interact with you directly. You connect your wallet, and that's the equivalent of signing up for an account. There's no need for that anymore. I find that to be kind of incredibly exciting, as it offers like this reimagining of how the internet's constructed. Instead of I set up an account with each application to kind of affirm my identity to them, to say, oh, well, if you really are John, you need to make an account that shows you're John. Now I just have an account. I say, this is John, and I connect it everywhere I want. And if I wanted to have 10 more identities, I can create 10 more accounts. It's up to me. But that's something that's a bit out there, but certainly we're very excited about, and I myself am personally. And so, yeah, and I think we're running up on time. So guys, thank you so much for taking the time to do this conversation today. Hope you enjoyed it as much as I did.
Absolutely. Thank you.
I'll hand it back to you, Gabby and Bruce.